when you have a fundamental need for a product and the market is not solving for that need, that's where your opportunity is.
This podcast is for advisor use only and not to be distributed to the public. The Wealth Consulting Group is an SEC registered investment advisor, and the opinions voiced and contents in this podcast are for general information only and are not intended to provide specific advice or recommendations for any individual. All performance referenced is historical and is no guarantee of future results. All indices are unmanaged and may not be invested into directly. The economic forecasts set forth in this material may not develop as predicted, and there can be no guarantee that strategies promoted will be successful.
Hello and welcome to the Bull of Wall Street. This is episode number 36. We're privileged and honored to have Zack Ellison be our guest today. Zack is the founder, managing general partner, and chief investment officer of Applied Real Intelligence. Based in Los Angeles, he's a CFA and Kaya charter holder. Welcome, Zack.
Thanks for having me, guys. Appreciate you thinking of me for the show. So,
Zack, I think the last time we chatted in person was at a Alts Silicon Valley conference. That was a couple of years ago, but we've stayed in touch. And so tell us about your journey. Tell us about, how you got where you're at and what you're doing.
Well, it's a long story, but let's take it back about 20 years. I graduated in 2004 from a small liberal arts school called Swarthmore College in Pennsylvania. And shortly thereafter, got into the financial markets. And really my first, I would say, bigger job on Wall Street was working as an underwriter of media and telecom and technology loans at Scotia Bank in New York through the financial crisis. And so that's where it was a lot of fun at first in 2007, and then everything went wrong in 2008 and 9. And I'll tell you this, that was the best thing that could have happened for my career, because I learned more lessons during that period than I think most learn in an entire lifetime.
That's incredible. Well, I feel like that's how it goes a lot of times, is you go through something really, really hard and challenging, and then you come out of it totally new.
Yeah. And so the takeaway there was that when things go wrong, you learn all about the weaknesses in the deals that you're doing. When things are good, risk doesn't really show up on the surface, but it quickly shows up when things get rough. So that was a great opportunity, I think, to just learn how things can go wrong in every which way, right? Because everything went wrong during that period, as you recall. And so I really enjoyed it, loved the team at Scotia, still keep in touch with the team to this day, but left in 2010 to go back to business school at University of Chicago on the Booth School of Business. And went there full time. I loved Chicago, learned a bunch, and decided when I was coming out in 2012 that I wanted to be a bond trader, corporate bond trader. And so I was very fortunate in that I got a job at Deutsche Bank at 60 Wall Street. And I was the only corporate bond trader that Deutsche Bank hired that year globally out of MBA programs. So I got the one seat at the entire global bank. And that was a big deal for me because, I'd really, kind of worked my way to it. I didn't really know a lot of people in finance. I grew up with single mom, low income, and was able, through hard work and education and a lot of networking and doing the right thing to get that opportunity. So that was very cool. I got to trade a lot of the corporate credits that were coming out of high yield following the financial crisis back into investment grade. So think of names like Ford and AIG and Sallie Mae and Ally and a whole bunch of others. And so I traded corporate bonds, but I also traded preferred stock along with credit default swaps, single name credit default swaps across multiple sectors. So that was very cool. I learned more there than I had learned anywhere else except for Scotia, of course. So basically the lessons at Scotia during the financial crisis, plus the lessons from Deutsche Bank, which was at the time the biggest bank in the world. They're 2.8 trillion in assets, largest bank globally. And we actually led the Apple deal, which I forget the exact amount, but I want to say it was 16.5 billion, if I'm not mistaken, in 2013. At the time, that was the biggest bond deal in history. And that was traded off my desk. I didn't trade it.
Oh,
But I
wow.
sat right next to the lead trader of that deal. And that was really cool. It was kind of like my liar's poker moment. Like if you think about like when people have these experiences on Wall Street that they'll remember forever, and that no matter what, they're always going to kind of stick out. It was that kind of moment, because what happens with bond trading, as you guys probably know, but listeners might not, is that when a company issues bonds, they basically go out to the market, or the banks that are helping underwrite the offering go out to the market, and they ascertain which investors want to buy the bonds and what size, and which bonds they want to buy, how much do they want, and at what price. And the bonds they're allocated at the end of the day, right? Typically. So you typically in the morning, you'll hear Apple's doing this deal, and all the big bond managers on Wall Street and all over the world will put in their orders with the lead bank, which was Deutsche Bank. At the end of the day, or throughout the day, but typically, near the end of the day, those bonds get allocated. On a big deal like this, too, of course, it's going to be near the end of the day because there's more bonds than ever to allocate. And so what happens, though, at the end of the day is a lot of investors don't get exactly what they wanted. They get more of some bonds than they wanted. They get less of other bonds. And so then they need to trade their positions around at the end of the day to get to their optimal mix, if they can, right? And so what typically happens is at the end of the day, there's a lot of trading, and the bonds are not yet in the system. They're not, it's all on paper. It's literally on notepads on people's desks, right? Or on their Excel file on their desktop, but it's not in a system because it's all kind of done the old fashioned way. Or certainly it was in 2013 when this happened. So the scene was, call it 4:00 in the afternoon. The bonds become free to trade. So meaning Deutsche Bank can then now start trading these the Apple bonds. And so the entire trading floor at 60 Wall stops, and you could hear a pin drop. And there's hundreds of these like big time traders and salespeople that just stop and watch Adam Scheck, who was the lead trader who sat right next to me, trade these bonds. And it was surreal because I've never seen a trading floor that quiet in my entire life. I've never even seen a library that quiet. And so to me, that was a very cool moment. And I still get goosebumps thinking about it because I thought, man, that's a lot of pressure right there too. Right? We've got the biggest investors in the world. We're talking, BlackRock and Vanguard and T. Rowe Price and PIMCO. I mean, you name it, like literally the biggest in the world, all calling up their salesperson, who's then basically telling the trader, hey, I've got a bid for this amount of this bond, and I want to sell this amount of this other bond, and he's doing it all on a notepad. Total old school.
Gosh.
Right? And I thought, man, that's what I gotta aspire to, right? Like that's as big as it gets, the biggest bond deal in history, traded by my bank, my desk, the trader right next to me. And I thought, well, that's what I aspire to do. And
that's
so
wild.
Yeah, that
that's
was
a cool
cool
story.
Yeah. I mean, we had a great time at Deutsche Bank. I mean, we were known as a risk-taking bank as well, for better or oftentimes worse, I think, in hindsight. But great experience there, just being able to interface with the biggest investment managers in the world on a daily basis, and have the ability to kind of learn how they viewed the market, how they did trades, right? How they thought about their portfolio in the context of the market, how they thought about managing the liquidity of their portfolio, et cetera. So that was a great learning experience. I did that for a couple of years, and then a number of my trading counterparties, Deutsche Bank's trading counterparties, took an interest in hiring me because they thought, well, hey, we really like dealing with you. Why don't you just come work for us? And so I, at that point, I think it was like kind of around 2014, I went to work at Sun Life, which is a large insurance company and asset manager.
Yeah.
Yeah, and they manage over $1 trillion in assets in aggregate. They're one of the 20 biggest managers in the world. They own MFS out of Boston, which is hundreds of billions, and some really
Yeah.
big real estate managers. And they also have in their insurance account, which is known as the general account, at the time about 150 billion. I don't know what they have today. Probably a
Hey
lot more than
Zach,
that.
these
Yeah.
these are Canadian institutions. Do you have roots up north?
No, it's funny. I'm not Canadian, but I consider myself an honorary Canadian. Well, I didn't even mention this, guys. My first job was actually at Thomson, which became Thomson
Oh,
Reuters.
Thomson Reuters. Yeah.
Yeah, and at the time, so this was when I first, basically when I first got out of undergrad. Thomson was, if I'm not mistaken, the largest company in Canada.
Yeah.
Even to this day, the Thomson
Wow.
family
Roy
is the
Thompson
largest.
Hall in Toronto.
Yeah, yeah. So I did that for, I think it was like 2.5 years. I was at Thomson in New York, and that was great as well. I was basically doing what's called equity markets surveillance, where I would help publicly traded companies understand who is buying and selling their stock, because they were always very um, they were always really aware of, or wanted to be aware of, if there were hedge funds or activist investors that were accumulating positions. So think of like Carl Icahn, right? That's the perfect example that most people would know. The last thing you want as an executive at a company is to hear that Carl Icahn is accumulating a big position in your stock. And what you want is to be informed of that as early as possible so you can defend against it. And so a big part of this was helping to guard against corporate raiders, in a sense. A bigger part to me was really positioning these companies and their story with a broader investment base to make sure that their message was resonating with the right types of investors. And what I mean by that is that they wanted to attract long-term aligned capital. So think about long-term investors. Fidelity buys you. If Fidelity believes that you're a good long-term play, and they invest billions, or hundreds of millions, if not billions, into your stock, like that's a good thing, because it's going to handle volatility. You're now partnered with one of the biggest investors in the world. There's a lot of credibility that comes along with that. There's access to more capital, and so making sure that their stories were optimized to attract the right types of investors and tell their story in the best way was a big part of what we did. So that was pretty cool, because I was 23, 24 years old, and I was talking daily with the heads of investor relations for Fortune 100 companies. Literally the biggest energy and utility companies in the world were my clients. And quite frankly, I didn't really know what I was doing at the time, right? I knew enough to be helpful and add value, but in hindsight, I think, wow, if I was back in that role now, what I could do with it, I mean, really, it's incredible. But that was a great learning experience. So I basically went from Thomson to Scotia to Chicago Booth to Deutsche Bank to Sun Life, right? And so it was this kind of progression where I was learning different parts of the market in different roles. First it was stocks, then it was underwriting, then it was trading, and then it was portfolio management and trading at Sun Life, right? And so, one thing I'll say that I do think is kind of unique about my background, a couple of things. One is, where I came from, which is no handouts and very humble beginnings, right? So that's my defining characteristic. But in terms of the work experience itself, I don't know very many people who have been on the buy side and the sell side, who have worked in both equities and debt, who have been a trader and a PM. And so that was kind of what led to this opportunity that I'm highly engaged in now, which is building my own fund, because I saw that there was really a gap in the market. And I thought, wow, this is call it 2018-ish, 2018, 2019. I realized that public markets were not going to be a place to generate sustainable alpha of any significance. It was just being it was becoming highly commoditized. There was very little informational advantage that you could gain. It doesn't matter if you're at PIMCO or Deutsche Bank or a single trader. Same kind of information is coming across at the same time for public companies. And a lot of the bond market was becoming highly electronified at that point, much like stocks went through that transition 20 years before in the early 2000s, where it went from kind of a high margin business that was over the phone to a very low margin business that was over the screens. Mm-hmm. And so that transition was happening, and I was acutely aware of it because I was actually speaking at a lot of conferences. Folks that run conferences would call me and say, "Hey, do you want to talk about bond market liquidity?" And how, because they knew that I'd been a buy side trader and a sell side trader. And so I at two of the biggest shops on the planet. So I had a very keen sense of how liquidity really worked, and from both perspectives. So I was, so I was talking a lot about it, and the more I learned about it, the more I spoke about it, the more I talked to other experts about it, the more I realized I got to get out of this. Like, there's no money to be made here. Like, it's not that interesting intellectually, and there's not really that much upside. I need to figure out where there is informational advantage, where there are asymmetric opportunities, where there's a lot of upside, but relatively muted downside. And so I started looking into the private markets because I knew that's where the opportunity set was. And of course, I wanted to stay in fixed income because that's where I had spent the majority of my career. And so at that point, I discovered a strategy called venture debt. And this is where the story actually gets very interesting. Venture debt is basically loans to venture-backed companies that are high growth companies that are looking for more capital to grow, but they're willing and able to utilize some debt in their capital structure because it reduces the amount of dilution to the ownership. Right? So instead of selling $100 million worth of stock in the company, they could sell 60 or 80 million of stock and borrow 20 to 40, and that would decrease their dilution, help them maintain their ownership stake. And so I heard about this through a mentor of mine has a brother who, I won't say who it is, but very, very well-known, successful VC who had made hundreds of millions of dollars for themselves, if not billions. And, I was talking to them about what I was looking to do in my career and opportunities I was looking at, and they basically turned me on to venture debt. They said, "Hey, look, if you take a look at this, I think you're going to be amazed at how big the opportunity set is, given your experience in fixed income, because there's a real gap in the market here that's not being filled effectively." And so I started really digging into it, and I started analyzing the market structure and the competitive environment and looking at who the players in the space were. I did this for about a year on my own time. And the deeper I dug, the more confidence I had that this was not only a good opportunity, but it was the opportunity of a lifetime. And what I mean by that is I kind of equate it to what Michael Milken must have been going through in the early 80s.
Oh, yeah.
When he was thinking about, well, hey, there's this opportunity for non-investment grade borrowers to tap into the capital markets. And at the time, there was huge resistance to that, right? There was called junk bonds. People like Moody's, amongst others, said, "Hey, these are literally junk because they're not investment grade." But Michael Milken and others, like Howard Marks, who was kind of my investment idol, looked at this differently, and they said, "Well, actually, the risk-adjusted returns here are far superior to investment grade if you've done the work on it." And Michael Milken had turned onto this through a paper he had read. That you could look up at some point, that the academic paper that kind of highlighted that these non-investment grade companies actually did really well on a risk-adjusted basis, and other people hadn't picked up on this. So long story short, the way I viewed it is he identified this fundamental opportunity whereby there was a huge segment of the market that wasn't accessing capital efficiently. These non-investment grade borrowers had this large need for capital, and they weren't able to tap into that because the market structure wasn't there for it. And so he basically built that market structure and said, okay, we're going to figure out a way to get capital to non-investment grade borrowers The market called it junk back then. Now they call it high yield, and virtually every fixed income shop in the world has high yield in their portfolio, right? And he became a billionaire and a legend, and as did Howard Marks. And so the takeaway for me was, when you have a fundamental need for a product and the market is not solving for that need, that's where your opportunity is. And I thought, wow, this is not going to be as big as the high yield market, but it's going to be huge. And here's why. More money and talent is flowing into innovation than ever before, and that's where the money's being made. That's where the talent is going, right? When I look at where MBA graduates are going, they're not going to accounting firms or the banks anymore. They're going to VC funds. They're going to tech firms, right? They're becoming, graduates are becoming founders and entrepreneurs themselves. And so I knew that there was this huge influx of talent that was going to be continuing to flow into innovation, and that it was cheaper and easier than ever before to launch and build and scale a startup, right? Because of all the technology we have. And this was before AI too, right? Now with AI, it's infinitely cheaper. I mean, you could build $1 billion asset manager with a team of 3 people. In fact, we're going to do that. We'll have a bigger team than 3 when we're at $1 billion, but I guarantee you we will get there, and I guarantee you we'll do it in a way that probably no one ever envisioned could have been done 10 years ago. So that was my takeaway. This was like 2018, 2019. I realized, holy cow, this is going to be one of the biggest markets out there. The market is innovation finance. Think of it like that. And as these companies grow and they get more astute about how they're raising capital, what their capital structure looks like, they're realizing that they should have debt as a permanent part of their capital structure in many cases. I'm not talking like early stage startups where it's 2 people and a laptop and a puppy dog and a PowerPoint. I'm talking about companies that are doing millions of dollars in revenue, but are trying to figure out how to scale that by 10x to 1,000x. And so these companies are going to be utilizing debt. And those that do it well will be utilizing it judiciously, and they'll be working with the right partners that can build the right types of financing vehicles for them. But all this now that's starting to become, I think, very obvious to the market, as we've seen this like boom in private credit, and within that a boom in certain niche areas of private credit. This was not a common thought or common knowledge in 2019, 2020. I'll tell you, I probably had 2,000 calls with LPs or potential investors. So for those that are listening, the LP is a limited partner that would invest in a private fund. So think of LPs as being, they can range from individual investors to family offices to institutions like endowments and pensions, et cetera. I've talked to over a couple thousand, and they all took the call because they didn't know anything about venture debt. So they wanted to know, hey, what is this? And in 2020, nobody cared. They were kind of like, hey, this is cool. Call me in 5 years. And now they all care because they realize, oh my God, you were right, Zack. The risk-adjusted returns here are higher than any part of the market. Like across the board, Jim, like we have the best returns across the board in risk-adjusted terms because you're getting senior debt risk, but with equity upside. Because basically the way it's structured is it's a senior loan to the company, but then you get equity upside typically through warrants, which are options to buy stock in the company. And so properly structured, you can basically have very, very low risk with very truncated downside, but also have unlimited upside. If the company does perform well, your equity could be worth multiples of the loan amount. But let me pause there because I've probably over-talked.
This is super helpful to hear all of this, Zack. I'm just curious. I don't know a ton about all of what happens with venture capital and what goes on, but I know there's the venture capital firms. There's some people that kind of do it on their own. And you said early stage versus late stage. I was just kind of envisioning like a PowerPoint presentation, no cash flows. It's kind of a coin flip for a lot of these companies, but it seems like you're going into companies that they're making at least $5-10 million or more in revenue. And, are you going in with other VC funds, or are you like as a side investor, or are you finding companies that are not getting the right bids from other VC firms? I'm just curious, kind of like how that starts. And then if they're like bank loans or senior loans, are they a duration of like 3 to 5 years, or is it shorter?
Well, these are great questions. So let's start from the basics. So there are two big segments of the venture debt market. One is bank lenders. So think about banks like Silicon Valley Bank being the biggest, but other commercial banks as well. And there's probably about a dozen banks that do this relatively well that have been in the market. And J.P. Morgan has a unit that does venture loans, Comerica, Bridge Bank, and a handful of others. That's one part of the market. The other part of the market is non-bank lenders. So non-bank lenders are typically funds that specialize in making these types of loans that don't have all the restrictions that a bank would have, right? Just like with larger loans, you've got the bank market where you can go get a $250 million loan from Scotia Bank, or you can go get a loan from A.R.I, Apollo,
Blackstone, one of those. Okay.
Et cetera. So it's the same kind of structure that you've got the bank market and the non-bank market. They don't you think of it as a Venn diagram where the overlap is not as great as you'd think. It's probably 10 to 20% of the companies are really like overlapping.
Oh, interesting.
And so I could write a whole book on just the two segments of the market. In fact, that'll be out probably next year.
Nice.
And I should mention this, actually. I do write a monthly column for Venture Capital Journal on venture debt. So Venture Capital Journal is a pretty good industry trade magazine that comes out. They've got articles every day, but every month I have a column with them that focuses on a different segment of venture debt every month. So I just finished up a three-part mini series on convertible notes, because that can be equity or debt in the long run, in the sense that it's a hybrid security.
Yeah.
So for those that want to learn about venture debt, I always just recommend that they read the 2 years of articles that I've already done. I mean, we're done with 24 articles at this point, and hopefully we'll have a couple more years coming. And so that plus work I've been doing at University of Florida, where I'm finishing my doctorate in business. That's the other thing that will be available pretty soon to read. I'm writing my dissertation on venture debt and the returns at a deal level across 20 years of data, basically. Because it's one thing to know what venture debt is theoretically, but if you're an investor or you're a founder and you want to know, where should my deal price? No one's ever done that work before. I'm the first person in the world to do it. And so that's going to be crazy. We've got 15,000 data points in my dissertation that were all hand accumulated, basically out of SEC filings. So it's
incredible. It's a lot. It's a lot of data, and I feel like a lot of people will benefit from all that data.
Yeah, I hope so. I mean, that's the point. I mean, it's a lot of work, and some people said, "Well, why are you giving people else great free information?" And my thinking is, well, the market's going to keep growing, and they're going to come back to the thought leader. So I don't mind telling them how it works. I win deals all the time because people come to me, they say, "Hey, I've read a bunch of your articles, or I've seen you on podcasts, or heard you speak at conferences, and we want to work with you." There's other guys that do this, or other firms that do this, but we want to work with you because you're the person that's educated us on the market. So I mean, I'm curious on your view on this. I mean, because you're always, you're in the space, not in venture debt, but in asset management and wealth management, wealth advisory. Do you think being a thought leader is one of the biggest differentiators in terms of getting the right types of customers?
I think it helps. I mean, I think so much of our industry now for advisors, really, clients look to them for education and like, what should I do? What should I not do? And I feel like it's our responsibility to do the same thing for advisors and for investors at large, just to educate them, let them know, there are good things that you can do. There are things that are not so good.
Yeah.
Right. To educate them. And I don't know, Tally, what your thought is. Tally's like a thought leader too.
Yeah. Well, I think it's a great question. I think it's a key part of your go-to market strategy. And from that perspective, I think you have to create mind share before you can create market share and really kind of grow the industry that you're spearheading. So I think it's crucial. And whether it's the podcast you're doing, I mean, we do that stuff, or crafting thought leadership articles, all this collateral. I think it's all kind of in the same ecosystem. So I think you're on the right track. But can I jump in and kind of shape the conversation a little bit,
Yeah,
Jim?
please.
Is that all right?
Yeah, go for it.
Zach, I want to thank you for sharing your personal story, because it really helps kind of connect you to our audience. And I just listening to you, I think you did a nice job explaining venture debt in layman terms for our audience, which is the financial advisor. And I think you started to kind of touch on, well, you actually did a great job explaining the benefits of this asset class from the company perspective, but you started to touch on the benefits from the investor perspective. But I wanted to dig in there a little bit for advisors, and maybe you could kind of walk us through there, how a typical financial advisor could leverage something like this. We're talking about alternative, assets in general, venture debt in particular, to enhance client returns and kind of improve diversification, if you will.
Yeah. So thanks for bringing us back on topic. So let's start with venture debt, and then let's talk about private credit, and let's talk about alternatives. We'll go from the bottom up instead of top down. We'll start with the micro and work to the macro. So in terms of venture debt, let me explain what it is in very simple terms, so everybody has a very crystal clear handle on what it is. So it's loans to typically early stage, but not necessarily, but venture debt is loans to venture-backed companies. Now, one thing I want to make clear is you can make a loan to a non-venture-backed company that's a bootstrapped company, for instance, that's never taking outside capital, and it can be very, very similar to venture debt. I would consider that, in technical terms, not to be venture debt. I consider that to be growth credit.
Oh, growth credit. Okay.
But it's kind of semantics.
Mm-hmm.
The way it really works is that any kind of early stage or growth stage company that's growing quickly, that's got venture-like characteristics, whether it's venture-backed or bootstrapped, I would consider that to be venture debt. But I just want to make that point clear, is that some people say, well, that's not venture debt because it's actually not backed by a VC. And that would be growth credit. But really, the market to me is both types, but they're kind of different segments within the broader growth credit universe, right? Now, this is important because there's different risk considerations with companies that have a good sponsor, a good VC investor, versus those that do not, right? They're oftentimes very different types of companies in terms of where they are in their development cycle, where they are in terms of governance, and where they are in terms of access to capital. Like if you're a company that's backed by one of the large VCs, you're going to have more visibility. You're probably going to have more access to capital, right? You're going to have perhaps more strategic support through that VC and their network, right? So there are advantages to actually being a venture-backed company. But then there's also some amazing companies that have said, you know what, we don't need outside capital. Or we didn't need it earlier in our life cycle, and we got here on our own, didn't have to sell any equity to get here, and now we'll take some outside equity to juice growth and kind of get us to that next phase, right? So the bottom line is there's pros and cons to both being backed by a good sponsor and not being backed by a sponsor. And I actually wrote an article, or actually I think I maybe wrote 2 articles on this for Venture Capital Journal, talking about the pros and cons of being venture backed and bootstrapped. So that's something people could look up, because to me, like, that's actually a very important consideration when you're looking at this space. Okay, so now back to Talley's question: what is venture debt and or growth credit? It's essentially loans to companies that are typically doing a minimum of, call it 10 million a year in revenue. Of course, there's loans that can be made to smaller companies. I've done that. Others have done that. But generally speaking, you're talking about revenue of 10 million plus all the way up to hundreds of millions a year. But I would say the sweet spot where you're going to see the bulk of these loans being made is in companies that are doing between, call it like 25 million a year and 250 million a year in revenue.
Wow.
And that are venture backed and that are growing at substantial year over year rates, anywhere from 30% to a couple 100% per year. So think of them as very high growth companies. They're typically very tied in with innovation. It doesn't mean they have to be a software company or a biotech company, although those are 2 of the largest segments, or an AI company. It just means that they're doing something innovative and solving some problem that enables them to grow very quickly. There's a demand for their product because it's something new that's meeting a market's need. Does that make sense?
Yeah.
So that's step 1, is kind of defining the borrower universe. It's these fast growing companies that have revenue. They typically, though, are looking for more growth capital because they're not yet fully mature. They're looking to continue to build out their product, their team, their market reach, et cetera.
Zach, I know on your site, you were talking about sectors there, which was one of my questions. I know you tend to be agnostic, but did I hear you right? So right now the bright spots are really biotech and AI related ventures.
Well, so let me reframe it a little bit. In terms of where the money has gone historically in venture debt, there's the 2 largest segments are software companies. And so a segment of that is software as a service, or SaaS.
SaaS.
That's a huge market because a lot of these companies have very, very high margins and a lot of recurring revenue, because they're oftentimes it's contractual revenue where you might pay, you might sign a contract for 2 or 3 years for a software service that you're using, right? And so that money is very sticky and the margin's very high, in the sense that adding an incremental user for a software company doesn't cost them very much.
Yeah.
So the margins can sometimes be 80, 90% or more, which is pretty incredible. So that's always been a huge segment of not only venture equity, but also venture debt, because it's a very lendable segment because of this recurring cash flow. So basically what lenders do in this segment is they don't really lend against hard assets like you would see with kind of asset-backed lending, where historically you'd say, okay, I'm gonna borrow money. What am I putting up as collateral?
Yeah.
Well, it's usually some form of property or some
real estate or something else. Yeah.
Exactly. And so one way to kind of frame venture lending is it's not asset-based lending. It's really revenue-based lending. Right? You're really lending against the revenue of this company and its revenue profile going forward. And you're not often going to be backed by hard assets that you'd see in other parts of the economy, right? Typically, the collateral will be oftentimes you can get a lien on all the assets of the company, but the most valuable asset for early stage companies is usually their intellectual property or their
property.
IP.
Yeah.
Right? So really what you're lending against is the revenue growth profile of the company. And then if all goes poorly and you need to, and you do need to rely on that collateral to extract value, what's the value of that intellectual property?
And Zach, I'm sorry, how far out do you lend? I mean, are these longer term, shorter duration? Is it similar to like regular bank loans or?
Yeah, great question. So typically the loans are, call it 2 to 4 years.
Okay.
And so the data that I was talking about earlier that I've analyzed for my dissertation shows that the average time outstanding for most of these loans is about 2.5 years. So because oftentimes they're paid down early. So imagine you're borrowing money, Jim.
Yeah.
You're a startup founder and you've got this great company and you're able to get a venture loan and it's a 4-year loan. Okay. Typically the way these are structured is there will be a period of what's called interest only. So you only pay the interest on that loan for the first, call it 12 to 24 months. Then the loan will start amortizing, meaning each period after that interest only period, you'll be paying interest, but you'll also be paying part of the principal, right?
Got it.
So this is not dissimilar from what you'd see with other types of loans. I mean, it's structurally like it's really like not that complex.
Yeah.
So let me just go back really quickly to Talley's question about the sectors.
Yeah.
And then let's go through all the structural stuff, and I'll try to nail it in one shot, so people listening can just go right to this point of the conversation and get all the details. So, in terms of sectors, it's sectors that are backed by VCs as well. So, what does that usually mean? Innovative, high growth sectors. Big portion of that is software companies. A big portion of that's biotech. Those are probably the two biggest. But you've also got a lot in healthcare, which is distinct from biotech. You've also got but you've got stuff across all sectors. Consumer is a big one. There's different risk profiles there. A lot of folks now are investing in AI, and so there's basically like the full spectrum. But I would say that the majority is in software, biotech, healthcare, consumer, AI, and then there's applications across all different types of sectors. Anywhere where you see innovation, right? It could be an industrial company with a new robot, or it could be a new way to process something, or a new physically or intellectually, right? There's and so once you kind of got that profile where you're generating 10 million plus in revenue, venture debt becomes an option. The loans typically are, like we just talked about, call it 2 to 5 years is the spectrum. I rarely, if ever, see loans that are longer than 5 years. Kind of the sweet spot is in that like 2.5 to 3 year range. You see a lot of loans with that type of maturity. And also you see loans that could be a little bit longer, like this 4-year loan we're just talking about, that could be paid down early. Like if the company raises more equity capital, or they're just doing really well and their revenue profile is very strong and they've got extra money, more than they thought, and they just pay down the loan because they don't want to pay interest on it. They don't need to have it outstanding anymore. So think of the time frame as kind of in that 3-year zip code, and then you've got in terms of structure, it's usually like a mid-teens type interest rate in the non-bank market. These are almost always floating rate loans. So it'll be prime rate or SOFR plus a credit spread. But that all-in interest rate is typically in the call it 12 to 18% range. A lot of it's kind of clustered around 13 to 15% cash pay. Some of the loans will have like a back-end success fee, meaning when the loan is exited, the borrower will pay the lender, call it like 6 to 10 points on average, right? Because the loan was successful, the lender took some risk, and therefore they're going to get some back end.
Interesting, like a kicker.
Yeah, a kicker, a cash kicker, or cash success fee. The other thing that you'll see in some of the deals is what's called a PIK interest, a pay in kind, which is a non-cash pay interest. So it basically accumulates, and at the end of the loan, it's paid in cash. So you might see that in 10 to 15% of deals. So if you think about the kind of return profile from an investor's perspective, and also from the borrower's perspective in terms of what they're going to be paying out, they're typically going to be paying out that mid-teens interest. It's usually paid on a monthly basis, not quarterly. as you'd see with larger loans, which is nice because you're getting the money back faster. Your IRR is higher if you're getting money every month as opposed to having to wait till the end of the quarter. So you also so along with the cash pay, you've got some deals that have this PIK interest, which is only typically a couple percent. That's just like a sweetener, right? It might be like 1 to 4% on top of the cash pay. Then you've got a back end fee on a lot of the deals, which could be a one-time payment when the loan is exited of, call it 6 to 10 points. So all that together, if you annualize it, it gets you to around 20% return. Or it should, otherwise you're not making as much as you could, right? Now, here's the kicker, though, is that the lender also gets equity warrants in the company, which is the right to buy shares. It's options in the company, basically. And those can be incredibly valuable if they're structured properly, because what you can often do as a lender is get what's called penny warrants, which means that you can exercise your right to buy a share of stock in that company for 1 penny.
Wow.
Per share, right? So what you typically see in most of these deals is whatever the value of the loan is. So say it's a $10 million loan, you'll get what's called warrant coverage, which would be a percentage of that loan amount in the form of warrants. And so typically that warrant coverage is somewhere between 5 and 25% of the loan. So in other words, I make you a $10 million loan, I'm getting 500,000 to 2.5 million in equity upside as well. Okay. So oftentimes those warrants aren't, wind up not being worth a lot, but with companies that do really well, they can be worth a tremendous amount of money, right? So if you think about this in risk adjusted terms, you've got this like steady income of 15%. Plus, some of these other kickers like the PIK interest, the back end success fee, and also prepayment penalty. So if the loan is paid down early, you often will receive interest for future periods that they would have paid had they not paid down early. In other words, say I make you a 4-year loan and you pay down in 2 years, I might still get 4 years of interest. That's called a full make whole. Some of the better lenders in the space insist on that, because it literally can double your IRR. And we've had loans like that at A.R.I that have done quite well, where they've done so well fundamentally, they've paid down the loan and paid down years of interest, even though the loan was already paid down. So we're basically, wow. I've had loans that have generated 150% IRR. I mean, in the last year, like this is not hypothetical. Like, our portfolio performance is incredible because of you get a couple of those, and then you're getting 20 to 30% on all the others, and your IRR shoots through the roof. We have one portfolio company now that I think could be 10 to 20x return, because we've got just like an incredible equity package, and they've done really well. And so, if that does as well as we hope it can, and that could really take our portfolio performance to better than equity VC performance. Like we would be in the top 1% of equity VCs as a lender, right? So this is why I love this strategy, which brings me to the next point, which is you're probably wondering about, well, how are these loans structured? What types of protections do you have, right? So the big thing here is that these are senior secured loans. So they're at the very top of the capital structure, and they're typically secured by all of the assets of the company. Okay, so you've got a first lien, like the first bite of the apple on all the assets of the company. Now, you have to determine, well, what are those assets worth in the down case? Oftentimes they can be worth a lot more than the loan, because if you structure it properly, the loan should be a small percentage of the enterprise value of the company when you originally underwrite it. Like, so folks would call this a loan to value. So value of the loan divided by enterprise value of the company. So if you take like a relatively conservative view of the company's valuation, and I'm not talking about a VC's view on what they think it could be worth, right? I'm talking about like a market-based view where you say, okay, here's their revenue, here's their realistic growth profile, and here's where the multiples would trade in the market. Like typically these companies are trading on a multiple of revenue because they're still not generating a lot of like EBITDA or profitability in many cases, right? Because they're growing. So they're taking all the money they're earning in sales and they're reinvesting that into the company, and their growth keeps going up, but you're not going to see like huge profits until later. Like think about like Amazon and Uber. Like neither one of them made money for forever,
for a long time.
And now and then they take over the entire market like that. So as a growth investor, you're not really thinking about how much cash is left at the end of the day right now. You're thinking, how can we get to this point in 5 or 10 years where they are dominating, right? And have big share in the market. So as a lender, you've got this security over all their assets. And typically the loan to value that I've seen across the space is with the good lenders that don't lose money, it is in like the mid-teens, typically less than 20%. So to put that in concrete terms, imagine there's a company that's doing 25 million, or let's say 25 million in revenue, and they're growing very fast, and they trade at a 4 times multiple of revenue. So they're worth $100 million enterprise value. And now you make that company a $10 million loan. So you made a $10 million loan to a company that's doing 25 in revenue, but that also is, let's say, expected to grow by 100% next year. So they're doing 25 million today. A year from now, they'll probably be doing 50 million revenue.
Yeah. And
today, a realistic value for that company is 4 times their 25 million in current revenue, right? So $100 million valuation, divide the $10 million loan amount by the $100 million enterprise value, you get 10% loan to value, or we call it LTV. It's hard to lose money in situations where you're talking about LTVs that are in the like single digits, or even 10%. Because what we're saying here, guys, is imagine this company now that's growing really fast, right? 25 million expected to double the next year. Let's say it doesn't grow as fast. Let's say things like don't go as well. They're not going to go from 25 million in revenue to 0 when things are, that's not going to happen. But they could, their growth could slow and their valuation could drop. The multiple will compress. So let's say their revenue goes from 25 million to 35 million, right? So now they've missed big time, right? They were supposed to do 50 million in revenue now, and they've only gotten to 35.
Yeah.
So now the multiple is going to compress, and investors are going to say, well, they're not worth 4 times because their growth has slowed. Maybe they should trade at 2 times revenue. So now it's 2 times the 35 million. So it's a $70 million company now, but you've still only got a $10 million loan outstanding. So you're still like 7 times covered. So for this company to go to the point where it's worth less than the value of the loan is very hard to do if you structure it properly from the outset. It would mean they would have to lose 90% of their value. And this is a company that's on the upward trajectory, right? So it's very unlikely that a company that's doing really, really well, all of a sudden is going to lose 90% of their value. If you've analyzed the fundamentals properly, right? There's a lot of examples where people don't. Like look at 2021, right? And they misprice them and they wind up losing money. But the key
that reminds me of the SPACs, some of the SPACs that didn't work out.
Oh, yeah. I mean,
2021.
Jim, there's so many ways to lose money in investing, right? Like, and so what I think about is all the ways not to lose money.
Yeah. And
I'll tell you, it's really not that complicated. Like you guys know this, right? Like there's very simple things you can do. So I think of this idea of this is the S rule. This is a rule that I've made up that's basically if you keep the loan small, right, relative to the enterprise value, like we just talked about, and it's senior in the capital structure, and it's secured, and it's short duration. So it's 4 S's.
Right.
Yeah.
The 4 S's. You've got small, senior, secured, short duration. Very, very, very unlikely you're going to lose money. Because what happens is if say you've got a loan that's 5% loan to value, and you're the top of the capital structure, and it's a 2-year loan, and you make this loan when things are going really well, look, I don't know what's going to happen in 10 years. We might all have, like robots living with us, and there might be no need for us anymore. I don't know. But I can tell you this, I have a 20-year track record of looking ahead 2 years and being right the majority of the time. I can look ahead with a company and say, okay, I can see where you are today. I have a very good sense of where you're going to track over the next 2 years, right? I don't know where you're going to be in 7 years, but I don't care, because I'm going to be out of this loan in 2. And that's the difference between venture debt and venture equity. And this is why it's such a compelling asset.
Yeah.
Because as an equity investor, you have to be right 10 or 20 years down the road. You had to be right with Amazon or Uber 20 years ago, right? But as a lender, I don't need to wait 20 years to know if I'm right. I'll be out of that loan in 2 years, recycling that capital into another company who also has visibility, right? And where I can understand their trajectory, right?
Yeah.
But here's the thing. You're not giving up the equity upside, though, because you're getting the equity warrants in every deal.
Sure.
So the winners,
if it works out, you can still do really, really well. But
exactly.
you said something a little bit ago. You said the fundamentals. I feel like the fundamentals are so important, along with the S, because if you don't get that right, then, and especially with the equity, right, the liquidity is not the same. You're waiting a long, long time. I'm thinking just like with regular venture equity, but with what you're doing is you're saying, hey, we just want a piece of this. We're not going to give you too much based on, the loan to value. We're going to put some kickers in there to make sure that we get paid well. And if they're growing, right, they're going to turn it over and they want to pay it, more quickly than you would expect. But Talley, did you have a comment?
Well, yeah. So if I'm a CIO or a PM, you did a few things there for me, and maybe I can just kind of summarize a little bit. So you helped me mitigate the risk. You explained that process with the S rule. I think that was very catchy and cool. So I'm going to remember that. But is it right to think about if this is an asset class, if innovation were an asset class, this would be it, venture debt. Is that fair?
Yeah, I think so, because one thing I'll add is that what happens here, guys, is if you start with the 4S rule: small, senior, secured, short duration, and you can also add a 5th S, which would be structure, right? I mean, senior secured is part of the structure, but there's more structure around that. So it's really easy to remember. You got your 5 S's, you get those right. But here's the thing: these companies, as they grow, if they do well, you now have not only a call option on the equity, you also have a call option on the debt, in the sense that most of them are going to say, hey, we did a smaller loan before. Now we've doubled or tripled our revenue. Let's increase the size of our debt facility. And as a lender, you have the option, if you structure this right, to provide them with more capital, or if they're not doing well, you don't provide them with more. And so what you'll see with a lot of these loans, this is what we do, and I think this is one of the biggest de-risking mechanisms, is whatever the facility size is, you don't fully fund all of it on day one. You give them a portion, and then the remainder gets unlocked if they hit certain milestones and do what they say they're going to do. Right? So imagine you make a company a $25 million loan, but day one you give them $10 million. The other 15 never gets unlocked if they're not delivering. So now you as a lender built in this protection, in that you've only made them a $10 million loan, but you also have all this optionality on easily giving them another 15 in incremental debt capital, plus you've got all the optionality with equity warrants. So if you structure these things right, you have so many levers of control that you would never, ever have in equity investing, for instance, right? And you have upside that you would never have in traditional direct lending, because you would never be able to get that equity upside in like middle market direct loans.
So this is a great point. So thinking about this from a broader portfolio construction perspective, fitting this strategy into the asset allocation, is it right to think about it like high income with a potential kind of equity kicker, if you will? I guess that's the word we're using.
Yeah, totally. I mean, where I see most folks putting this in their portfolio is in the fixed income
Mm.
portfolio. So if they've got a private credit sleeve, that's where it should go, because ultimately it is a private credit product. But I've seen other folks that put it in like an absolute return bucket
Mm.
or an income bucket. Um, sometimes people put in opportunistic as well, right? I'm talking about like institutional allocators, and
Yeah.
everybody does things a
Yeah.
little bit differently. But the core bucket really is private credit, and then but it also satisfies these other needs. So part of the reason why it's been a little bit hard to socialize the strategy with the market
Mm.
is that it's not a clear cut strategy that falls in a nice little
Mm.
neat box.
Style
And that's
box.
That's
yeah.
It
fair.
doesn't
So
fit in a
Jim
neat
and
box.
Tally, to your point, Jim, yeah, it doesn't fall inside a style box. And so a lot of people say, well, we don't do that because we only do equity, or we only do like this type of credit,
Hmm.
asset backed credit, for instance. And this is why there's a gap in the market, because one of the things I've learned, and that I'm sure you guys are acutely aware of, is that the market is very siloed. Like it's like a million flavors of ice cream, but none of them mixed, right? And so it's like you've got your VCs that do one thing. VCs that invest in growth stage SaaS companies, and then you've
Yeah.
got another VC that only does like early stage biotech, and then you've got
Hmm.
your fixed income investors that only do investment grade credit, and then you've got folks that do like only like high yield, and then you've got folks that only do convertibles, right? Like the
Yeah.
market doesn't have many players that are go anywhere capital. And that's actually what my fund is evolving into. And that's why like I'm super excited, because
Mm.
so the fund is called the A.R.I. Senior Secured Growth Credit Fund. It's a lot to bite off. A.R.I. Senior Secured Growth Credit Fund. But so what we do are these loans to venture backed and non venture backed companies that are growing at a fast clip and that have some innovation angle, right? But ultimately, here's what that leads to. That enables us also to do different types of structures. Sometimes companies want to do a convertible note rather than a term loan. Sometimes they're looking for equity capital, which we don't do directly out of the fund, but we can support that through other structures. Like we've got two portfolio companies right now that we're raising money for and investing in through an SPV, what's known as a special purpose vehicle.
Hmm.
So imagine, and we've lent money to the company. We've already done the diligence. We love the company. It's doing incredibly well. And they're like, hey, listen, we want to go raise some equity capital. Well, we've already got all the information on the
Yeah.
company. We've already got a relationship. So instead of bringing that to a VC, we can raise the money for them. And we can also invest through this special purpose vehicle directly into equity. And not only in these, we've got a couple deals right now that are actually very different. One is an early stage, kind of like seed stage deal. That would be a very kind of traditional seed stage VC type deal.
Mm.
The other is much later stage. They've already done 500 million in lifetime revenue, and they're raising a much bigger round through a convertible note. Well, A.R.I. is leading both of those, right? Outside of the fund. So think about this, what this means. Like Tally, I can see you both you guys are picking up on this. Think about if you're an investor in the fund. Well, now not only do you get this, this like really consistent low risk income with the equity kickers in the loan portfolio, but now you're also going to get first look at the equity opportunities, right? And that's where there's more massive upside, because the key to the private markets is access and
Yeah.
timing. If you don't have access and you can't move quickly, you'll never do a good private market deal. And so this fund structure that we have at A.R.I. is what creates this incredible access to the best deals. And when we help them with the equity side, they've already been seasoned. Like we already know they're performing. This is not like, hey, first money in. These are loans that have maybe already been outstanding for 12 or 18 months or longer, that have performed really well, that we've already done immense due diligence on. And not only due diligence, but now we've received cash payments from them for the last 18 months.
Yeah.
Right? And so we know that they're a good company. We know what they're doing. We know, we know what their, kind of like operations and upside really look like from the inside. And those are the types of opportunities that we want to bring to our investor set, right? And so that's where it all kind of comes together. You can almost think of A.R.I as evolving into like a venture lender that also does non-venture lending, that does all types of hybrid capital, that also does equity. And so it's almost like a merchant bank combined with a direct lending shop.
Do we have time for a granular question? As I'm going to surprise you
Sure.
as the macro guy here, because
Yeah.
you were kind of talking around it. But how, Zach, personally, how do you assess the credit worthiness of these young companies? And what are some of the qualities that you look for from company management and leadership? And maybe because you were talking about some of the deals there. In your experiences, can you talk about, some of the things that went right and maybe some things that went wrong that you learned from?
Yeah, no, that's a great question. This is a fun topic. So ultimately, the most important thing is the fundamentals of the opportunity. When I say fundamentals, it's really macro. Tally, you'll appreciate this, or both you guys will. But the macro, is there? What does the market look like for this company and their product? So that's kind of like one starting point is the top down. What is the total addressable market? What's the serviceable available market? And you can look up all these terms online, and it's kind of like this is how the VCs talk about it, and that's the right way to think about it in many respects. Is what is the market? Not only how big can it be, but most importantly, in my view, is who are the competitors? Like what are the competitive dynamics? So you can do what I would call like the Porter 5 forces analysis or SWOT analysis.
Disruptive,
So all the stuff you learn in business school or at like any good investment shop, that's the type of analysis people do on the market, right? So they figure, okay, let's do an analysis on the market and the industry, and then let's start to dial in on the product, right? Like, does that product actually like deliver something that the market needs? Like I was saying earlier about venture debt, there's a need for this in the market. That's why I'm so bullish about the opportunity and why I continue to look smart talking about it, because it just keeps getting bigger and it's only going to get bigger. Like there's no way but bigger, because there's a fundamental need. The founders want this kind of capital, and the investors want these kind of returns. And so when you've got tailwinds like that, all you have to do is make sure you're in that wind stream, and you're going to do quite well. So I would say start with the market, then dial into the product, and then the product market fit, of course, right? Like how well does that product fit the market? That's a starting point. Then of course you really have to, with these earlier stage companies, understand the strength of the team. The earlier the company, the more the team is important. Sometimes you're almost just investing in the founder in a sense, right? Like, do you believe that that individual or that leadership team can execute and do what they say they're going to do? Like, to me, that's the ultimate litmus test. Do I think this team can do what they say? Because if they can, or they can get even close to it, then I'm feeling pretty good, right? But it's hard with the early stage companies, and this is why you see a lot of misses with VCs, 80-90% miss rate. It's not that they're stupid. It's just that there's not enough data or track record, and so you're really just betting on the person. You're betting on the founding team. Now with venture debt, it's a little bit different because you're not coming in that early. You're coming in after you've seen traction. You've seen that there's exactly
success.
And the way I frame it for people that they seem to understand is, think of it as like a horse race. Okay, like you go to the horse track, and you're an early stage equity investor, early stage VC. You're literally just betting on a bunch of horses, and you don't know anything but the name of the horse. You're looking at the betting options, and you say, okay, there's 25 horses here. I'm going to bet on the 20 names that seem the coolest, like, right? Oh, that one's a cool name. I'm betting on that. You spread your bets around, and you hope that one of the 20 is going to be a winner, right? Now, as a venture debt investor, you're not doing that. You're saying, hey, you know what I'm going to do? I'm going to wait until the race is 80% run, and then I'm going to place a bet. And here's the thing. The upside won't be as great. Like, I'm not going to get 1,000x return.
Mm-hmm.
But I have a pretty good sense after the race is 80% run if these horses are going to win, place, or show or not, right? And you're not always going to be right, but you don't necessarily need to be right on all of them. You just need to know that on average, when you're betting that when they're 80% done, you have a pretty high probability that if you make enough of those bets, you're going to make like a pretty nice risk-adjusted return. So that's kind of how I think about it is, look, there's merit to both approaches. They're very different, right? Early stage equity investors are playing a numbers game and the power law and hoping they get, they invested that one big winner that's going to do 1,000x return. And venture lenders are doing the opposite. They're saying, I just don't want to lose money and I want to hit a lot of doubles, right? And maybe I hit a home run or two, but I don't need to. Like, I can lead the league in doubles and I'll still be an all-star.
So I've got a question, Zach, on like all of this, everything that's happening with AI right now. And, and then you hear about stories of companies that they're not really doing anything and it gets disrupted and other companies are coming in. And I feel like there's a lot of acquisitions before they even get close to becoming public. There's other companies that buy them or maybe they're in a space where they're too reliant on, government initiatives. I'm thinking like solar, wind companies, and then kind of the bottom falls out. So like, I feel like you want to avoid some of those where there's policy risk, but for those companies that get taken out, you guys just get paid off early. And if there's like a prepayment penalty, you just get paid off early. So you're making the whole return in like 1 or 2 years instead of 4 or 5. Is that usually how that works?
Well, I wouldn't, I don't know. I wouldn't say usually. I wouldn't say that, the average company is not going to pay off, in 6 months and give you 4 years of interest, but it does happen more often than you'd think. Right.
So when they get taken out by another larger company, do they just keep the debt on the books typically and you still get paid or?
Yeah. So typically, the most in terms of like exiting a loan is I think what you're getting at. So there's a couple of ways. The most common is probably them raising additional equity, right? So they go raise a big equity round and like, well, we just raised a bunch of fresh capital. Let's take out that loan that's charging us 15%.
Yeah.
Right. So that's probably the most common way. Another common way is just organic cash flow, right? Where that happens quite frequently. Actually, that's probably the most common for us. Certainly, we're looking for companies that never need to raise additional capital. Right? Like we expect they will, and we want to help them with that when they do. But if they don't, that's fine. We're not like waiting for a VC to like bail us out with additional capital. So let me reframe that actually. So I kind of misspoke. I would say the first path of exit is just organically generated cash flow. Like the company generates enough revenue where they just pay down the debt. They're paying the interest. They just pay it off and they're happy and everybody's happy. So that's the most common. The second most common would be that they raise another round of equity and they use that to pay it down. Then of course they can, they oftentimes will get bought, right? In which case the debt would be paid down. Those I would say are the most common. Then also another very common exit is another lender as the company grows comes in and says, oh, well, now the company actually is a middle market company, right? They've gone from 25 million in revenue to 150 in revenue over 3 or 4 years. Well, now there's lenders that will lend to them much more cheaply, right?
Oh,
so imagine banks will then come in and say, oh, well, you don't need a 15% loan. Like you should pay that off and we'll give you a 6% loan.
Yeah.
Because now you're de-risked. And so that's actually another very common exit is just refinancing from another cheaper lender. And that's a win for the original lender because now you're taking out all your risk, but you keep all the equity. So what you want to do, guys, if you do this right in an optimal way, you want to be recycling this capital frequently. You want to be in loans that are paying off in 1 year, 2 year, 2.5 years. And you want to be keeping those equity positions, which you will. And so you wind up building this giant portfolio of equity options. And then you keep recycling the risk and earning 15% cash. So you're getting paid 15% cash to own a basket of ever expanding options in the fastest growing companies in the world.
Wow.
Like, to me, like, if you think about it, that's what this is. Like, that's what A.R.I does. And that's why it's so compelling, because you tell me another strategy where you get paid 15% to then get de-risked, but own, you know, a ton of upside in all these diversified companies. I mean, it's incredible. And then along the way, not only are you earning the 15%, but you're protected by these structural features as a senior lender that are, you know, keep you in the most de-risked, advantageous spot in the cap stack.
I feel like that optionality is like, not too many people focus on that and like how that can pay off later on. It's an asymmetrical return outcome, right? So like, yeah, there are chances for losses, but then it's positively skewed, as Talley sometimes will refer to us. Like, we want to have that positive skewed asymmetrical outcome, which is great. And frankly, I wouldn't even mind, you know, putting something like this in an equity bucket if the returns are double digit. Call it equity proxy or equity like. Certainly going to be differentiated than everything else that's equity like, you know.
Well, Jim, I think that's a great point. And I actually had another, you know, very smart investor like yourself say kind of something similar to me offline. And I haven't heard that from many, though. I'll tell you, I've only heard that from probably half dozen people over the last couple of years. So you're one of them. So you're already in the top half dozen. But they kind of said the same thing, which is, hey, if you're getting equity returns, and like, this is much better than preferred stock. Like, you're getting a higher return than you get with a pref.
Yeah.
But you're senior to them, and you also have, like, you know, this uncapped equity upside in the form of the warrants. So technically, it's not equity; it's a senior loan. It's better than equity. It's less risky than equity, but the return on the upside actually is equity.
Yeah,
it's better. I mean, it's better than a preferred stock, because
you got lower downside too, a lot lower downside.
Exactly, and you know, the challenge I've been dealing with, and I'd love to get your thoughts on this, guys, is, you know, how do we get this socialized with, you know, the wealth management segment, right? Because we know that there's this big push into alts, right? We see this like every day in the news and in the press and on LinkedIn and at industry conferences. Everybody's talking about, how do we get into alts? How do we get into private credit? How do we get into PE or VC? And you know, so things are moving positively, I would say, in terms of creating more access. But I think there's just like huge gaps in terms of like the market structure that is keeping a huge segment of the population out of these types of products that really would benefit from them. So like, I'm curious what you guys think about how we create more access is the question.
Yeah, I don't know if Talley has thoughts, but I would probably say that a lot of this challenge is getting the vehicle right, understanding the liquidity profile the right way. And as you know, Zach, there's a lot of product marketing that goes on. I'm not knocking marketing. I think that, you know, there is certainly a place for that, but a lot of confusion where people maybe try to put things in buckets where they don't belong, or, you know, private credit, I feel like, is a good example where there's all these different private credit out there, but like, they're all different. They all have different risk profiles. And so, and then some of them are more liquid than others. And so for the end investor, and I would say even for the advisor, it's just the education, like helping them to understand what is what. No, you're not going to call this cash if there's a 20%, you know, return potential. But then it's also not a drawdown vehicle that's like private equity. And so people understanding where it goes, how much you should own, what's prudent. What were you going to say, Talley?
No, I think you're spot on. I mean, I think education is the great equalizer as we like to say. And I would keep it very high level and conceptual. That's why I was always trying to drag us back up to the 30,000 foot, like, because we can get granular very quickly with this kind of conversation. But just kind of helping advisors understand where this type of vehicle fits in the broader portfolio. But you personally, Zack, I think you're onto something there, getting on to the conference bandwagon, because there's organizations, as Jim will tell you, like Titan or Citywire. They create captive audiences, and they make sure that their advisors and CIOs, they're sitting and listening to you and your philosophy and your product. And so that's key. I don't know if you've spoken at the Milken conference, but maybe you could start there.
I haven't spoken there, but I'm actually, Milken has what's called the Young Leaders Circle, the YLC, which was, it's like a couple hundred people globally that are selected to get to go to the conference and partake in everything for free. So I've been a Milken YLC member for a number of years. So I've been to the conference multiple times, but have yet to speak. I think this year coming up in 2026, usually it's in May, and I think it'll be different this year because some of the companies we're working with, whose deals will be announced later this year, are so significant that if we want to be on the stage, we'll be on it. I think
brand names, that's going to help. Yep. Make noise any way you can. And I would say, because I was asking Jim before we came on, hey, do we own his fund? And so that's the key for a hybrid RIA like the Wealth Consulting Group, trying to get on to the platform like LPLs.
Yeah.
I don't know how you do that, but Jim, maybe you have some ideas.
Yeah, well, that's challenging, and it is probably a little bit easier on other platforms, but like, of course, you have to have the operational and investment due diligence process in place, and just understand. Yeah, I mean, I think the challenge that where some advisors are scared is someone gets in there and they don't know what it is, right? And they're like, I thought it was something else. I thought I could get my money. I feel like liquidity is, and it's not just you, it's private credit, it's private real estate, private equity, even some of these, there's late stage venture interval strategies that you're kind of getting in late. But there's these things, sometimes they're priced daily. I don't know how accurate that is if it's private, but you can get your money out every quarter. So yeah, I think just finding the right vehicles, finding advisors and educating them. The conferences are helpful. I think what you're doing just with your podcast and working with venture debt in general, just educating people. But I wanted to switch gears if we could, because I see you're partnering with some athletes or maybe one athlete, and you've got a Lights Out Sports TV and a Lights Out Extreme Fighting. I know it's not exactly related to venture debt, but like you're investing in this, and it's just fascinating, right? All the different angles you can go with things that want to borrow. They're growing, and so tell us a little bit more about that. We only have a few minutes left here.
Yeah. Sure. Yeah. No, I appreciate you guys staying on for this long. Or I think we're 90 minutes in. So this is almost like a Joe Rogan type length. Right?
Like we're not going to go 3 hours, but
yeah. So Jim, what's really cool about like what I'm doing for me personally is that I have the discretion to focus on what I think is the most interesting and where there's the most upside. And that's ultimately why I became a founder and entrepreneur myself, and built A.R.I. and the fund and all the SPVs and from scratch, right?
Yeah.
There's a big trade-off. Like, don't get me wrong, that was the hardest thing I've ever done professionally, and it's still a big challenge. Because all the things we were just talking about, the operations, the marketing, the fundraising, it's probably do like the equivalent of like 10 jobs, right? Just like any founder would. But the trade-off is, the upside to that is that I have discretion, right? And I'm not getting told what to do by an investment committee that's 10 years behind the times. I'm forward looking, and I'm going out to find the most attractive opportunities in the world, in my opinion. And so the reason I prefaced what I'm about to say with that is to say that now I can look for really interesting opportunities in terms of sector and structure and founder type and geography and business model that I wouldn't be able to do in a bigger shop where it's very siloed, like we talked about. Like, look, I liked all the shops I worked at. I have nothing bad to say about any of them, but they were very structured. I did like one thing. It was like playing the same level of a video game every day, right? And there's different characters that pop up in a level, but ultimately it's the same thing.
Same game.
Yeah. And once you've done it for a couple of years, you're like, I've literally mastered this. There's nothing more that I can really do here except beat the level every day. And that's really not that interesting. And so I wanted to find a space where I could be creative and find new opportunities. And so this goes to your question about like when you're asking about like the sports and entertainment and media is one of the sectors that we're highly involved in. And that's partially a function of my background that began at Scotia Bank, like we talked about, underwriting media.
Oh, yeah.
And so I was, this was 2008, the NFL, the NBA, Major League Baseball, all the big TV broadcasters, a lot of the cable channels. These were all like clients that I looked after. Like these were like my clients, right? And so, I wasn't like, I was a very relatively young person at the time, but my formative years in the industry were formed there to a large extent, right?
Yeah.
And so I've always kind of had an affinity for and an understanding of these sectors, like media and sports and entertainment. And so I've had the opportunity through A.R.I to really get involved with some of the most exciting entrepreneurs in the space. And one of those is the company that you named, Lights Out Sports, which is a company that was founded by Sean Merriman, who was an all-pro linebacker for the Chargers. His nickname was Lights Out because he knocked out 4 guys in one high school game, and then trademarked Lights Out. Right, he owns that. So when you see folks using it, like he's getting paid. If like Nike is using the Lights Out.
Lights Out. I love it.
Tag, So that business is interesting. I mean, it basically includes what I call like a feeder league to the UFC. It's an MMA league, essentially, that you would call like an MMA promotion, very much like the UFC, just like the minor league to the UFC. It's a feeder league to the UFC. The folks that do well in Lights Out Extreme Fighting get called up to the UFC. It's kind of like playing in the G League or minor league baseball, and you get called up from AA or AAA to the big leagues. And
it's like Here Comes the Boom. I'm thinking of the movie Here Comes the Boom, where he started off.
Yeah. So Lights Out has the feeder league to the UFC, but they also have a streaming sports channel called Lights Out Sports TV.
Oh, wow.
That has a bunch of niche sports channels that you can watch on any connected device. So whether you're on your phone or laptop or connected TV, you can watch all kinds of cool niche sports that are hard to access elsewhere. So things like kickboxing and women's rugby and off-road racing and hunting and fishing and chess. I mean, you name it. There's all kinds of very cool niche sports. And the thinking there is those aren't necessarily big enough to be on ESPN in the middle of the day, right? They're not, they don't have a big enough audience. But when you have 30 or 40 of these sports and a global audience, it adds up pretty quickly. And so that's a pretty compelling model. And one of the things I've looked at quite closely is the streaming television space. So you've probably heard of, certainly you know what streaming TV is, but FAST channels, which are free ad-supported TV, and that whole ecosystem. There's a whole bunch going on there because it's not just content. There's builders that you can invest in as well. So I know and have relationships with the top streaming television builders and platforms in the space.
Wow.
And so what started as an investment as a loan to Lights Out Sports quickly deepened into other areas of the space, and then that in turn it's led to other opportunities in the space. Like now, where we've made a loan to one of the top, I would say that one of the top 10 entertainers in the world, with 200 million plus followers. I guess I shouldn't be so specific because there's only a handful of people. But wait until this fall when this news breaks. This is one of the most well-known people in the world. We're the lead investor in their company,
Wow.
and they've already done hundreds of millions in revenue. And so little old A.R.I. that nobody took seriously 3 years ago is now leading the deals that they would all give their firstborn to be part of.
Wow.
Right?
Congratulations. That's awesome.
That's great.
Yeah, no, it is awesome. I'm pumped about it because the amount of work that went into it is insane. And the amount of people that said no to me is probably, I'd say 99.5% of people, or 99.8%, somewhere in that range.
Wow.
That's the amount of people that didn't believe in the vision or didn't believe I could execute on the vision. And now they're all wrong. So it does make me happy, I must admit. There's nothing that makes me happier than proving people wrong that doubted me. So Jim, just to wrap up the thought though, what's cool is there's a huge space right now, a huge opportunity in sports, entertainment, and what I would call the mega star led brands. Right? So you've no doubt seen there's a lot of focus and some very high returns from celebrity linked brands. So think about Casamigos, and think about Kim Kardashian's Skims, Rihanna's Fenty, Roger Federer's On Running. Hailey Bieber sold her company for $1 billion on 200 million in revenue, 5 times multiple in May, right? And that segment is growing because the world has changed. In terms of how we digest content and how consumers spend their money. This old model of we watch TV and we're presented with ads, and then we go buy some of those products, or maybe we see a billboard or hear a radio ad. Long gone, right? We all know that now we're consuming on social media. We're consuming on Instagram. We're consuming on TikTok. We're listening to podcasts for ideas. Right? We're not watching linear TV anymore. We're watching streaming. We're watching on demand. And so what that means is, and I'll tell you guys, the investment community has not caught up with this, and they're not even close. And I know this because as I'm working on some of these deals, I'm talking to a lot of investors in the space, and they're like, oh, they're thinking they're way too slow. They're going to miss the boat by 5 years.
Wow.
We're already there, and they're kind of well, this guy's got 200 million followers, and they don't understand what that means. They don't understand the power of the fact that you could put up a new product. This influencer could put it on Instagram, and 25 million people are going to see it tomorrow, and it's going to cost the company nothing.
That's wild.
Think about what that would cost. If you wanted to put up a Super Bowl ad that was, very short, never changed, it's going to cost you a ton of money. You can have long form content, you can have interactive content, and you can do it for free and reach an engaged audience. People are watching the Super Bowl, but you don't know if they like your product, right? You're paying to get this out to hundreds of millions of people. Maybe only a couple million actually give a crap about your product, right? But imagine now your influencer who's got 200 million people that follow every post you put up, and then you tell them, hey, this is the new product. This is what's cool. This is what you guys should be looking at. And they do, right? And so the punchline here is that authentic brands led by megastars that with huge followings are this new kind of subsegment that of the, I would say, celebrity associated brands that didn't really exist before, right? Because we didn't have megastars like this in terms of 200 million followers. You didn't have that until the last couple of years. And so that to me is a very compelling space. It's very small because there's only about a couple dozen people on earth that are big enough individual brands. But the best comp I would say, guys, is look at like Jordan Brand within Nike, like the Jumpman, right?
Yeah.
Jordan Brand is estimated to be worth $6.5 billion.
Mm.
$6.5 billion with a B.
Wow.
Jordan doesn't play anymore. He hasn't played in 25 years. Right?
Yeah.
Right? Like, yeah. So here's the thing. There are other similar, iconic folks that will also be able to create brands like that, but it won't take them, 40 years.
Yeah.
Jordan 40 years, Jordan Brand. But now you can create that same type of value in like 5 years. Like Kim Kardashian's brand is worth more than Jordan Brand. In
that's
some people's
wild.
eyes.
I read somewhere that Adam Sandler is now like the wealthiest actor more than anyone else because of the deal he got with Netflix. And apparently Netflix said that there was like 100 billion minutes log that people watched of his movies. So they gave him this, what is it, like a $275 million contract over like 2 or 3 years, something like that. It's pretty. But like, I feel like people are using the data and they're looking at, like you said, the influencers, and they're seeing what they can do and the numbers, and it's like you said, it's not the traditional way of we looking at media and advertising. That's super fascinating.
What's very interesting is it was very hard to track stuff in the past. Nielsen would send out polls and ask people what they were watching. I mean, that's like so antiquated, it's laughable. Now you can see exactly what they're watching, when they're watching it, where they're watching it from, and you can match that with the exact demographic that they come
and the
from.
social media and the views and all of that. Exactly. Wow.
I mean, think about how powerful the algorithm is, or the algorithms are on some of these social media platforms. I mean, I use Instagram as an example because many people use it. And if you use Instagram, consistently for one day, it'll basically start sending you stuff where you're like, how did it know that I wanted to see this? Like the algos are so powerful now that they can really dial in on things that you don't even realize that you want, right? Or that you might need. And it happens very quickly. I mean, that's why TikTok's done so well. Their algo is amazing, right? I mean, forget the fact that they're like stealing all our data and who knows what they're going to do with it. But on the plus side, if you look at what they do well, is they know what you want, and they figure it out quickly, and they then push that out to other folks that want that, and it's so fast. I mean, this is that whole idea of virality, right? It's like with all the algos and with all the people that are tuned into their devices like 24/7 nowadays, seemingly, the right product pushed out by the right person who can create that initial momentum, like just can take these things like through the roof.
Wow.
Yeah. So anyhow, I really appreciate you having me on, Jim.
Yeah. Thanks so much for joining us. We appreciate you having us. Zack, Ellison, thank you so much for being with us. And we'll catch up maybe another time. Maybe I'll be on your podcast. We'll have you back.
Yeah, let's do it. The 7 and 7 show. We're bringing the top investment minds. So I'll have you on that. We're launching season 3 actually this fall. So I'll get you on that for sure, Jim.
Very, very cool. Thanks so much, Zack.
Hers and his, three's company too. Come and dance on our floor. Take a step that is new.